As someone who runs the Treasury Department, sometimes receiving tax revenue just isn't enough for me.
I'm late.
I need more to get my projects completed.
I'm late.
So I just go out in the market to make a loan. Short term, long term, whatever you...
So sorry I'm late. Who was that guy? Anyway, let's get into bonds. To the lab. Understanding the bond market will help you understand what interest you will pay on things like a mortgage or receive in your savings account. Further to what that other guy was saying, a bond is essentially a loan, but you are the one who lends money to the corporation or government. The bond market is one of the largest markets in the world, being estimated to be valued at over $130 trillion globally. A bond itself, though, is made up of pretty simple components: the value issued, the interest rate, and the duration of the bond. The bonds we are going to focus on are United States Treasury securities. These are considered pristine collateral. Any individual or business that wants a loan is far more likely to be extended credit compared to any other form of assets in the world if they hold US Treasury securities. Also meaning, if this particular market was to fail, the entire global financial system wouldn't function, and the currency we use today would no longer have value anywhere in the world. There's actually another reason to focus on the US Treasury bond market in particular. US Treasuries can be used to predict impending doom which is about to hit the global economy. We'll go over that later. But first, some terminology and details about how bonds work. Different US Treasury durations have different names. Any duration less than 1 year are known as Treasury bills. Durations shorter than 10 years are notes, even though traders do refer to those as Treasury bonds too. But the Treasury refers to bonds as securities with greater than 10-year duration. So how are these Treasury securities created? They are sold at auction. Hundreds of these are held every year, but it's an online auction. Individuals are only able to place non-competitive bids on their Treasury Direct account at these auctions, meaning they accept whatever bond yield, otherwise known as a discount rate, is available. Institutions, on the other hand, can use their Treasury automated processing system to place either competitive or non-competitive bids. Competitive being a specified interest rate which they are willing to accept. Institutions also have the ability to trade in advance of the auction, known as when issued market, which allows insight into the anticipated auction conditions. This auction will determine the yield for a particular Treasury duration. A little side fact: the 10-year bond will give a clue to the direction of mortgage rates from commercial banks. The bond yield is how much we will earn each year for holding the bond. In fact, yield of different Treasury durations is how we can identify trouble ahead. But it's still not time to go through that. First, I'll explain how bonds get their yield. Let's say the Treasury Department wants to raise $100 million in 10-year notes, which has a yield of 5%. So we'll need to start an auction for it. First, the non-competitive bids are accepted. And for this example, we'll say it's 10 million, with 90 million left for competitive bids. These are the competitive bids that were received at auction. All these bids exceed the 90 million left to auction, so the lowest bids are taken until the full value of the remaining 90 million is reached. This occurred at the 5.05% mark, with 30 million worth of $40 million of bids being filled. As the orders were filled at the 5.05% mark, the whole $100 million worth of treasuries were auctioned off at 5.05%. To identify the success of the auction, traders will refer to the bid to cover ratio. This is simply the total value of bids for a treasury auction divided by the amount of bonds sold at auction. So using our example, the BTC is 1.4. A successful BTC ratio is usually above 2 and usually exceeds the BTC figures of the previous 12 months. So the 1.4 BTC that we just showed is a poor performance, but a total bond auction failure would be a BTC below 1. This failure is catastrophic. Yields would explode higher, devaluing the world's most pristine collateral, meaning the world's assets collapse in value because of the mad scramble of meeting existing debt obligations, exacerbated by an intense demand for US dollars, resulting in a blow-up of the whole financial system. But for now, there is a remedy to this issue. The reverse repo facility offers an avenue where commercial banks receive an attractive rate to buy overnight treasury, which will allow the Treasury Department to use these funds to fill the remaining value at auction. If no one wanted these bonds at all, then interest rates would skyrocket. But that hasn't happened, so disaster averted for now. But why does a bond lose value if the yield goes up? Up sounds good. Does that mean lower yields are good? Don't worry, this is easy enough to explain. We'll use our example from before. Let's say the day before the $100 million 10-year Treasury note auction, we bought a 10-year Treasury contract at 5% for $10,000. This 5% is the coupon rate. The bond holds this rate for its entire duration. Here's the formula to work out this bond's value, but in the description I have a bond calculator that allows you to measure the value of bonds between each other. But now after the auction, the new interest rate which the market can get is 5.5%, which decreases the value of the bond we bought the day prior. The reason the value of your bond went down is because now anyone can spend the same $10,000 as we did. But they get a higher yield than the coupon on bond we have from the day before. So if we were to sell our bond, we need to lower the price to compensate for the lower yield the bond is carrying. And if bond yields were to explode higher, like we said before, you have a circumstance where values go from this to this. Hey, but just for fun, let's change these figures to the current value of the US bond market. Oh whoa, ouch, that would create quite a mess. But hang on a sec. How do those big players in the bond market know if bond yields should be higher or lower? It depends on the market expectations of inflation and the health of the economy. These players, like big banks, governments and corporations, have a lot of insight into the global economy as a whole because of their interactions with each other. They have insights into things that us normies only find out when it actually happens. As an example, a global pandemic was declared by the World Health Organization on the 11th March 2020, with some believing it began in November 2019. However, the bond market was saying there was just something strange going on in the market from August 2019. Are these related? Being a normie myself, I don't know. But look out for this symbol. Later, I'll drop it where the bond market figured out something was wrong. And you can make up your own mind if they knew or it was a coincidence. But anyway, back to the bond market. If the economy was booming, in order for the Treasury securities to be attractive, it needs to offer a higher interest rate, which is the yield we've been talking about. There's much less incentive for an investor to want a bond if the strong economy offers higher returns elsewhere. It's the same with inflation being higher. Investors will need to be compensated higher than the rate of inflation because purchasing power is lost. In environments where economic growth is poor or deflationary, then interest rates on Treasury securities will be low. But wait, remember we have different durations of Treasury bonds. They range between 1 month and 30 years. This matters because we can see the expectation of the most sophisticated market in the world of what will happen in the future depending on the duration of the particular bonds. So the interest rate on the 1-year bond gives us a clue to market expectations of the economy during that duration of 1 year. And if we lay out the bond yields all down together, we can see they are different. This is because economic expectations are different depending on how far out we look. We can look at these bonds yields and come to the conclusion the market anticipates that inflation or economic growth will have steady growth over time. This will offer the bondholder with higher yields the longer the duration, in order to compensate them for the inflationary or growth period they could otherwise invest in. Now, these were make-believe yields. We can apply these same principles to US Treasury yields in 2024 to see what the market thinks. What? These yields look all jumbled. The 2024 yields are telling us if you lend your money to purchase this 1-month security, you will be compensated with an annual yield of 5.36%. But if you lend your money for 10 years, you will only get an annual yield of 4.47%. Doesn't that seem strange? You are lending your money for longer but getting less compensation. It doesn't make sense. But can I tell you a little secret? Come closer. It does make sense. Remember what the market is telling us with bond yields, economic growth and inflation expectations. So if we look at these wonky bond yields, the market is telling us that growth and inflation expectations are higher in the short term than they are in the longer term. This phenomenon is called yield curve inversion, otherwise known as an inverted yield curve or danger ahead. Just so we are clear exactly what we mean by yield curve, let's go through it. Then we can go through what it means for the economy and stock market in particular. It's the yields we showed before, the ones with different durations. They are just plotted on a graph and is usually shaped like a curve. Bam. Yield curve. Each yield curve shape means different things. A normal yield curve indicates economic conditions and inflation are at a steady growth rate. A steep curve means strong growth. A flat yield curve suggests tempered expectations with little to no growth, while an inverted means negative growth and economic weakness ahead. This is the curve at May 2024, which has this kind of shape, doesn't it? Okay, we have an inverted curve today, so does that mean the market is going to crash? So we should sell all our assets and go into hiding until this mess passes over? If that was our strategy, we could be waiting a long time. Not a lifetime, but long enough that being out of the market could fill us with a full feeling of regret. Because the market may have gone a lot higher while we were waiting for a big crash. So it's a timing thing. Does the inverted yield curve tell us that date of when this crash will come? Nope. But we can use the yield curve inversion to tell us there's not much longer until this predicted market downturn will arrive. To do this, we need to be more specific about which aspects on the curves we focus on. We are going to look at the most common yield curve indicator, which is the 2-year, 10-year curve. Here's a chart of US Treasury yields between 1976 and 2024. In blue is the 10-year yield over that time, and we are wanting to identify when the yellow 2-year yield falls below that blue line. That's the inversion. The shorter duration 2-year yield has gone higher than the longer 10-year yield. On this chart, I've marked the inversion date with those yellow lines. Now notice when recessions are overlapped on the chart, shown in purple. So history tells us that when we have yield curve inverts, recessions follow. Okay, well, so what? Recessions result in people losing their jobs. It's a normal part of the business cycle. When times get easy, businesses take more risks. But that risk can lead to difficulty or failure, which flushes out those businesses out of the system, which are job losses. And this could be global. If businesses within the economy as a whole aren't performing as well, this will show up in the stock market eventually. So let's have a look. We'll focus on the S&P 500. Interesting to note, as an example, investing at the market peak in 2000 would mean you wouldn't get a positive real return for 15 years. Anyway, when we drop our inverted yield curve cycles on the chart, we can see that after the yellow inversion cycles, there is a fall in the stock market, shown in red. But hang on a sec. What's this inversion cycle? What's that mean? Let's zoom in a bit and have a look at each of these time periods. But again, just so we know what we are looking for in terms of these inversion cycles, a confirmed cycle is when we get the inversion in the curve. So the yellow 2-year line gets above the 10-year blue line, and it uninverts back below the blue line, but it has to remain uninverted for more than, let's say, 3 months to confirm the cycle is completed. It's nothing too scientific, so let's have a look at some yield curve history. The 2-year 10-year curve inverted in August 1978. The top chart shows this as the yellow line going above the blue and remained inverted until May 1980. The bottom chart shown in cyan is the S&P 500, and that from highs to lows of this inversion cycle lost over 18%. Soon after, in September 1981, was a period of multiple yield curve inversions and uninversions, with the uninversions being for a short duration. The S&P 500 here had a high to low loss of 33%. The 1988 cycle was similar, multiple occasions of inversion and uninversions until the confirmed uninversion. The same thing happened with the 1998 cycle and the 2000 cycle. The 2005 cycle was the GFC downturn, as was the 2019 cycle. But what about 2024? There's a lot of uneasy faces out there, and looking at the chart, the yield curve inversion cycle had started in March 2022 and has been inverted since July 2022. So what does that mean? Does the curve tell us that recession is coming and that the stock market is about to crash? We can clearly see that previous inversion cycles were followed by a downturn and a recession. But we can also see that it's impossible to anticipate the beginning of a downturn based on the yield curve. The start of a downturn has been inconsistent between cycles. Some cycle downturns occur during the cycle and others shortly after, and some months after. Some cycles are quite long in duration, lasting a year or two, while others may last just a month or so. So the bond yield curve inversion has been a warning signal, but not so much a tool for timing a downturn, but something that could be used as a kind of trouble is even sooner rather than later indicator is the Fed. What has happened in the past is when the Federal Reserve commences rate interest cuts after a hiking cycle, a market correction usually follows. But again, what is next for the market with the 2024 inversion cycle still to play out? There are arguments going around that the yield curve doesn't matter anymore. The Treasury has been issuing a much larger sum of Treasury bills over the past few years to fund their huge spending numbers. So we have a much larger supply of bills, and the Fed has a policy to keep interest rates higher for longer, so they are buying the bills from the Treasury and keeping the yield high, which is the conclusion of some experts that the yield curve is no longer relevant, that we can't refer to it because of the unnatural supply of bills by the Treasury is purchased by the Fed, which is why the stock market has been accelerating higher since October 2023. Only it's bills that are being supplied to a greater number. Why then are the notes, which is the 2-year, still yield higher than bonds? Maybe then the yield curve does matter. Maybe we need to wait until the current inversion cycle plays out. Maybe this time it's different, or maybe it's worse, that it's the same as before. With the possibility of drastic outcomes, it makes it even more important to keep cool, stay humble, and be kind, even behind closed doors.